Hi there, guys. Good morning. So we're going to carry on talking about the accounting equation. Here we are. The accounting equation. And I'm going to go through a PowerPoint. And this really, well, this is part 2, actually, if you like. This is part 2. And what this is really a continuation of part 1. I guess that's obvious. So make sure you watch the video on part 1 and then come back to this. And we're going to carry on with this accounting equation theme, building and growing the accounting equation. And so the key point is that you're able to sort of see what's taking place conceptually, see the big picture, so that when we come to do sort of the intricate issues or the internal issues, like when we actually record what's happening, you actually know what's taking place. Okay, so let's go to the PowerPoint and we're going to go through that. So here we are, the accounting equation part 2. So let's quickly start by looking at what the accounting equation is. You remember we said the accounting equation was assets equal to capital plus liabilities. We defined an asset as something that a business owns, controls, uses to generate income. Yes, we defined capital as money borrowed. It doesn't have to be money, actually. We discussed this, I think. Anything borrowed by the business from the owner. And we define liabilities as something similar, but this time not borrowed from the owner, but borrowed from maybe financial organizations or a supplier, if you like, when you purchase an item but you don't pay for it. So the trade payable, for example, is an example of a liability. Okay, so we have this very nice, neat equation, and where in accounting we're saying we must always recognize both things that have happened. This will develop into this whole idea of the double entry, which is really the language we use to record or justify this equation. Okay, let's build on this equation. We're going to add some new letters, but they're all still very much part of the accounting equation. Let's start again very quickly, go through this video. It always helps you to remember what's taking place. Let's start with a simple scenario. Chloe wants to start a flower business with £10,000. That's the accounting equation. Step 1, money in the bank of 10,000 is equal to capital of 10,000. The 10,000 there is, yes, money owed by the business to the owner, and that's the actual 10,000 you're seeing in the bank. Yes. Now, I've put the asterisk on the money in the bank. From now on, we're just going to refer to it as bank. If, for example, the money wasn't put in the bank and it was put in a cash till, then it would just be cash. So you can see there are two different accounts, if you like, but they're both assets. Just one is sitting in the bank. One is in a bank account and the other is, if you like, in a cash account, which is a till, with direct accessibility to. So they're both assets, two different forms. Okay, and we've already discussed what capital is. Yes. Okay, let's move on very quickly. So now let's carry on. Step 2, the business needs more money. You can actually do this in slow motion, so you can actually do the T accounting yourself. So you can actually draw up the accounting equation and just sort of, play with it yourself and see if you can actually know what the next slide or what it's going to look like. Decides to go on to borrow some more money. The business goes to the bank to ask for 20 grand. So I'll take you to the next slide. And this is the situation. So step 1, you have the bank, 10,000, capital 10,000. Step 2, the bank gets an additional, oh, ouch. Yes, here we are. Actually, yes, the bank, step 2, the bank gets an additional 20 grand. If you like, there was an already existing capital of 10 grand and their new liabilities of 20 grand that it has borrowed from the bank. And so you have a total here of 30 being equal to 10 plus 20. Yes, do you understand that? Let me just go back to this page and just do something here. Yes, so again, that step 2 really was saying A is equal to C plus L. Step 2 was saying you have acquired a loan of 20,000. yes, you have acquired a loan of 20,000, but you also have 20,000 in the bank. Initially, you had 10 that you had borrowed from the owner, and you had 10 sitting in the bank. And when you add everything together, your equation remains true. 20,000. Yes? Okay, let's go back to our PowerPoints. Okay, here we are. So, in step 3, the business decides to acquire another asset, a truck, by paying for it with money from the bank. And the truck is worth 15. So you play with that quickly and see what you think. You can pause the video before we go on to the next one. What you see really is a change in the asset type. Yes, the business is just exchanging one asset for the other, and you'll need to understand this when it comes to us actually preparing the accounts, if that makes any sense, or drawing up what we refer to as T accounts. But getting this idea in your head that, okay, I'm just exchanging assets. One asset is falling, one asset is increasing. That's why that equation remains the same. Two things are happening on the left side of the equation. Yes? Okay. And that's what you have over there. You can see you have step 1, we've done. Step 2, we've done. We have the total. Step 3, we have the bank falling by 15,000. Yes, because 15,000 is leaving it. And suddenly we're acquiring a truck of 15. Yes. So you see the new equation there. The total ends up being the bank of 15, the truck of 15 being equal to 10 plus 2,000. The equation is still balanced. Right, okay, let's move on to the next thing. So the business decides to buy a machine, but does not have the money to pay for it. So they're going to get a machine, they're going to own a machine very soon. They will have the asset of machine, but they say to the people they're buying the machine, let's just call that machine company, that we will pay you in a month's time. And the machine is going to cost 6,000. What do you think? Have a go, play with that. And then we'll go on and see what it's doing. You can pause the video. So this is the situation here. That's step 4. You have acquired a new asset, a machine, but you also have acquired a liability. Yes. So you have step 4, you have machine, 6,000, and you have a liability of 6. And what you now have, you can see here in your totals, the bank, the truck, the machine, and that's equal to 10,000 plus your machine, your loan, plus your machine liability. Yes, that's really, that machine liability just means the machine company. That's the piece of paper showing that you owe money to a machine company. As the 20,000 under liabilities is a piece of paper showing that you owe money to a loan company. The capital of 10,000 is a piece of paper showing that you owe 10 grand to the owner. But the actual money itself is sitting in the bank. The actual truck is under assets, and the actual physical machine is under assets as well. Okay, let's look at the next thing. So we're going to introduce a couple of ideas, a couple of new ideas. In your homework, I asked you to look at a few definitions: asset, expense, income, those sort of keywords. And we agreed in class that an asset, if you like, is something that a business buys for the long term. I guess for now we will argue that it owns it or it controls it, and the aim is to generate income. There is no intention, just for this simple argument, there's no intention, and I'm talking about a certain type of asset, there is no intention to sell the asset. Yes, if you're going to sell something, it's probably an expense. Yes, or you're either, so for example, when you buy, stock or inventory to sell, that's an expense because you're getting rid of it. And we'll discuss how, and when we buy to sell it, we really call it purchases, right? Or an expense. It's an expense, but purchases. Right. So that's the key point. That's the key difference between an asset and an expense. You spend money on both, but, as in the asset of bank will fall when you acquire a new asset or when you pay for an expense. But anyway, let's do that. So here are the definitions. An asset is anything a business owns, controls with the purpose of generating income. An expense is a cost that occurs due to day-to-day running of the asset and recognized separately. We've talked about some of these: purchases, of what the business actually sells. So some other people call this goods for resale. Yes, purchases, lighting, heating. There is no question of long term. This is the key point here. Okay. So the business decides to buy some goods for the purpose of resale worth £2,000. That's the aim, to sell goods worth 2,000. We refer to these as purchases. Yes, as purchases. Okay, here is the story. So what do we have? So step 5. Yes, you can see I've added another letter to this equation, and I've added it on the left side of this equation. This is just how we build the ideas in accounting, or the language in accounting. All I've done is I've added an E to the left side of the equation, and let's see how it works to keep the whole thing still balanced. What happens now is £2,000 leaves the bank, right? Because we've paid for these expenses, but we've acquired these expenses. So you can see here that step 5 shows your purchases of 2,000 and your bank of 2,000. Yes, and you can see that the equation, if you come down to total, is still exactly, yes, it's still exactly the same. Please ignore the 6,000 on the row of step 5. I'm going to have to deal with that and take that out later. But look at the total. Yes, the total. You have purchases of 2,000. You have the new bank, truck, machine. Nothing has changed with capital. Nothing has changed with the liabilities, of a total of 26. Yes? You can see that carrying on. So now we have expenses. We have recorded the fact that we have bought some goods. Yes, that's what we're doing there. We have bought some goods, and we've recorded that fact by recognizing the expense. Okay, let's look at the next thing. So I've added E. And you can see here what we have is a reduction in the asset of bank and an increase in the expense. So equation remaining balanced. Now they want to buy some more goods worth 5,000, but this time they want to do so on credit, as in they don't want to pay immediately, and they will do so in a month's time. So they're going to now, if you like, be dealing with a supplier who will say, you know what, take the goods, pay me later. So that supplier becomes what's referred to in accounting as a trade payable. They owe the supplier, and they intend. So now they have an obligation, a liability to pay someone in the near future, because they have taken something to use now. Yes, that's what a liability really is. Yes, you've borrowed, you've taken something, you're using it, you're enjoying it, but you haven't paid for it. Okay. So let's look at the scenario here. Step 6. Purchases of £5,000 is what they've taken now. They have an expense here, but you can see that nothing has happened with under assets, because nothing has happened. But what has happened is you suddenly have an increase in liabilities. Yes. So you have purchases in step 6 of 5,000, and you have trade payables all the way over here of 5,000 as well. Yes, an increase in liabilities. So look at the totals over here. What we have here, we have our new total purchase figure. So far, we have purchased £7,000 worth of goods. Bank, truck, and machine have stayed the same at their figures as at step 5. Capital has stayed the same. You still owe 10 grand. You still owe the loan. You still owe the machine company, and you now have acquired a new liability of trade payables of 5,000. Okay, let's look at the next one. So here we are. Now the business has bought these goods. Well, I guess it makes sense that they should sell them. Now, normal people would just think, well, if you sell something, once you see the money in the bank, that's it. You know you've sold it. No, not in accounting. I'll say that again. Once you've sold something, once you see the money in the bank, then you know you've sold something. No, we must recognize the sale as well as the money going into the bank. Yes, so we recognize the sale by the letter I, income. Yes, so we recognize the sale, because you'll see sometimes you don't always get the money because you might have sold on credit. So if you're always waiting to look into the bank before you know you've made a sale, well, you'll miss all the sales on credit. So we must recognize the sale because potentially the sale could have been made on credit. Okay, so we recognize when you sell something as I, and we'll see what happens whether the money goes in the bank or not next. So for example, here we are. The business sells some of the goods that it bought, and it sold the goods for 4 grand. We don't cancel out the expense. You know, we recognize a separate and new transaction recognizing the I of the income. So here we are. Two things must be recognized: income as a sale and money in the bank, because in this occasion, they do receive money for the goods that have been sold. So where are we? Really, okay, that really shouldn't say step one. Where? Wait, sorry. Oh no, this is 1 second. Let's find out what's happening here. Okay, it's further down here. So really, this should say step 7. I'm just changing that right now. That's the amazing thing about recording live. Right, here we are. Okay, step 7. Here we are. So let's see. Let's try and go back to the full view again and see if it shows. Okay, so step 7 here. You can see that I've brought in the I, and I'm recognizing the I on the right side. This is just convention, and you'll see I'm recognizing the I on the right side. Yes, so here we have income, and here we have the money going into the bank. So we have sold something, and we also recognize the money going into the bank because we have a new asset of money as well. So look at the total now. The purchase is still showing. Money in the bank has gone up. Truck, everything showing. Loan company, blah, blah, blah. And you also now have this I over here showing as well. So the equation remains balanced. Yes? Good. Let's look at the next slide. Here we are. Just to reiterate, every transaction is recognized, and there are 2 events for every transaction. And income is recognized with the letter I. Okay, so this time the business sells some of its goods for 8,000. Yes, so the business makes some more income, but this time the customer does not pay. The customer promises to pay in a month and signs the document saying, I will pay you later. Yes, or I guess really the invoice is enough. You know, the invoice, the sales invoice is evidence that is enough evidence, if you like, but just to make you, to drive home the point that the business doesn't have money, but it has another type of asset, and that asset is referred to as a trade receivable. Yes, and that asset is referred to as a trade receivable. So let's see. So this time it's for £8,000. Yes, it's for £8,000. So what do we have here? Actually, £8,000. Yes. So yes, it seems that a letter has come in too early, but we won't talk about the D for now. Here we are. What we have here is the £8,000, if you like, that has come in, a new asset, but that's the additional income. Actually, that you can see that says 12 right now, so really that should be saying, I feel like I'm missing a slide. Let me just see what's happening there. Okay, I'll amend this so we can see that what's really happened is, yes, that we had initially, if you remember, we had a 4. If you go back a slide or 2, oops, sorry. Yes, you can see what's really happened is that we have, you know, an 8 that's come in, an additional sale. Yes, that leads to that 12. So that's the 8 that's just happened now on credit, if you like, that we've sold some goods on credit. So we've made income of 8, but we've also acquired an asset, a trade receivable, someone owing us a piece of paper. And we discussed in class, we can sell that piece of paper. We can sell it. In fact, we can sell it for money. So for example, the whole aim is that when he pays us, this will go, this will fall in value, and that 8 will turn and come into the bank. So the movement will happen only in assets when the person actually pays us. Yes, we're just keeping a record of the income, and we're keeping a record of the purchases, you know, but movements can happen within. Yes. Okay. So the aim is for you to always be flexible and be thinking things could be happening in just one place, you know, and constantly being open-minded and thinking what's going on. Okay. The final letter we're going to talk about is D, and D stands for drawings. Now, when the owner, yes, takes money for their own personal use, or if you like, when the owner takes or withdraws some of the capital it's invested in the business, or if you like, when the business pays back some of the money borrowed from the owner. Yes, we call that a drawing. Yes. The thing is, owners misbehave. They take, like £5, £10, £20 out, from the business bank account for different things. So really, they're borrowing money from the business, really. So, but the thing is, it's not an actual full payment of capital by the business. It's just, the owner just borrowing money from the business. But really, they are withdrawing their capital or reducing their, if you like, the owner is reducing their what they owe or what the business owes them, if you like. But we'll see. You know what I mean. So here, when the owner draws money, we recognize it as a D. We don't say, oh, let's just reduce C. We say, let's actually recognize it as drawings because we want to know what happens throughout. We can do the full calculations at the end of the period. But for now, let's recognize everything as drawings. So what do? We recognize, yes, at the end of trading period, it's all going to happen. But let's just see how it works. So, an example, the owner withdraws £1,000 from the bank account of the business for their own personal use. This is always the issue here. It's for their own personal use. It's not for the business. So we call this a drawing. So what you see is there's been a fall in the money in the bank, but there's going to be an increase in the drawing. So what we have here, as you can see, there's 1,000 here, is that the bank, this is this step, if you like, step 9, the bank falls in value by £1,000. He's taken out £1,000. I guess you could argue, well, Owen, I could also put £1,000 here. You could, but we don't do that. You could, because technically that is what has happened, but we don't do that. We actually recognize on this side, on the left side, this sort of another letter called drawings with 10,000. Sorry, with 1,000 as well. So you can see the equation remains balanced. At the end of the period, we're going to play with that in a second. We'll do all the subtractions. But you can see here that because the equation is balanced, what we have now is 1,000 plus 7,000 of purchases. The bank has fallen by 1,000, so you have a bank of 16,000, and that's equal to, let's make this so we can see everything. So, oops. Yes. So that's you can see that. That's what's happened there. That's 12. Yes, and that's what's going on. Okay, so you've learned a couple of new concepts today. We've introduced, let's quickly. So we've added 3 new letters. E for expense, I for income, D for drawings. And that's how they fit into the accounting equation. At the end of the year, what we're ultimately interested in is profit. So let's play around with this so you can really see what the fun is in this, really is. So what have I said today? So I started off saying we have A is equal to C plus L. Then I said to you, well, we have this new guy called E that we add here is equal to C plus L. Oops. Let's get rid of that. Yeah. And then I said, well, then so this is like 1, and then I said we have 2, and then I said we introduce the E plus A is equal to C plus L plus I for income. And then I said to you, well, actually, the next step, well, actually, even just here, just if we look here, ultimately, every business is interested in profit. And what is profit? Profit is I minus E. So let me change my letter, my coloring. Now, if you remember in mathematics, if I want to find out what profit is, I need to find I minus E. How am I going to find I minus E from this equation? Yes, well, what you do is you subtract E from both sides, isn't it? So if I subtract E from here, this becomes A. And of course I have to subtract E from this side as well. So that becomes C plus L plus I minus E. I minus E is equal to P, if you like, or profits. So really, if you like, what we have is a scenario where we have A is equal to C plus L, and we always add profits back to capital. Take all this, remember this, you'll see as we prepare financial statements, you'll see that the accounting equation is really the foundation of all your financial statements. When you look at a balance sheet and things like that, if you're looking at things like that, you'll see how this all is derived. So that's your P. That's where we're going eventually. But this equation is just to give you a background, or Right. So my page isn't very big. I'm going to create a new page. say there's no need for that. So quickly jumping back again, we are at the point where we've said we have, let's just go back to the original equation. We have E plus A is equal to C plus L, C plus L plus I, and then I introduced the new D drawings, and I said we can have D plus E plus A is equal to C plus L plus I. Eventually what's going to happen is you're going to have this situation where you will have A is equal to C minus D, because eventually, remember, D is drawings. Ultimately, we're going to subtract D from C, ultimately. Yes, where we have plus L plus I minus E, because I minus E is equal to P, and you're going to have that P over here. So this whole bit, if you like, is the second part of your balance sheet, but you don't need to know that. The key point is I'm just helping you and just trying to get you to derive this equation. What I'm more interested in is that you're comfortable with this sort of this being able to manipulate movements with D and E and A and C and L and I. The next video I do will be about movements, and I will be using arrows to show what happens when one goes up and the other goes down and that sort of thing. You know, things like that. Okay, right, we're almost at 30 minutes, half an hour. Let's quickly tie this up. So, and of course, we will expand all of this in the, you know, in accounting equation part 3 and work through that. Okay, great stuff. Thank you. Have a good weekend. See you during the week. Bye-bye.